joining the webinar today. We really appreciate it. We're 1 past the hour, so we're going to go ahead and get started. I am Pat Soldano, President of Family Enterprise USA. We advocate for generationally owned family businesses and their lifetime of savings at a national level in Washington, D.C., all sizes of business and all industries. We're very pleased to have with us today one of our sponsors of FEUSA, Fiduciary Trust International. The topic that we're going to discuss is year-end strategies to maximize your charitable giving. We're going to discuss year-end charitable giving strategies to consider as we approach the end of 2023, so the timing, I think, is perfect. This will include deciding how much to give and where to focus your giving. It will also include determining how to make your gifts outright in trust, donor-advised funds, private foundations, and evaluating those tax-smart strategies for your giving. I am delighted to introduce Abby Axelrod, Wonderman, and Brian Kirk of Fiduciary Trust International. Fiduciary Trust was founded in 1931 by families for families. They provide comprehensive wealth management services with a personalized boutique touch. As their name implies, everything they do is with your best interest in mind, free of conflict and free of any bias. Abby is their philanthropic director, and Brian is their director of estate and financial planning. So welcome. I'm going to turn it over to Brian, and he will start the presentation.
Great. Thank you, Pat, and thanks everyone for joining us today. Like Pat said, we're going to focus on charitable giving today. Multiple reasons for that. We are at the end of the year, and so November, December, society's focusing on giving. We know a lot of the clients that we work with also are focused on giving, and not just to their family members. They're giving to the organizations that are having impacts in their communities. In some cases, this is regular activity that they're involved in. For some, it is new activity that they're doing. And Pat, like you mentioned, we're going to talk about tax strategies because as we look at ways in which to minimize both income tax as well as estate and gift taxes for folks, charitable giving is one of your main tools, if not the main tool, for managing your tax liabilities. And it is fully supported by our government. Our government provides a lot of incentives to do charitable giving. So we'll talk about some of those and how they factor in to your end of year giving process. And so, Abby, I'm going to start it off. I wanted you to maybe kick us off here. I know a lot of folks come at year-end giving with a very clear idea of what they're going to do and who they're going to give to. But we also have clients you and I work with who realize that they should be giving. Maybe they have been giving to organizations, maybe been doing some sort of what a lot of people call, sort of checkbook philanthropy. And maybe they just don't feel that great about the work they're doing, which they really should. And they are sort of questioning this sort of how do they go about finding organizations or figuring out those causes that are going to have the biggest impact for them personally. I know you do a lot of this work, so maybe you can start us off by just talking us through how you approach that problem with folks.
Yeah. Yes. Thanks, Brian. And I'll just move to this next slide. So it really starts by first articulating what you care about. And it sounds so simple. And in some instances it is. So think about what your motivations and your values are for your giving. And this really allows a donor to be impactful with their giving and really proactive in their giving as well. So ultimately, you want to think about your motivations and your values being the foundation for and rather even your anchor for your decision making in your philanthropic planning. And so I often work with donors around 3 main points. So the first is to reflect on your values, ask and answer questions about what is motivating you to give, where do you hope to spend most of your time, what kind of change do you want to see in the world? That's the first. And then once you clarify those values, you move into reflecting on your specific focus areas or your issue areas. And those are things like, arts and culture, education, healthcare, environment, international giving. And so once you solidify those, then you can move on to writing a mission statement. And so you take your values, you take your focus areas, and you write a personal mission statement. And this is something that is meant to kind of be your North Star, so to speak. It will help guide your intentions on giving. And anytime you sort of have a question about where your choices are, where your dollars are going, you can go back to your mission statement and reflect on it, because that is really what's articulating those initial intentions.
Yeah, and Abby, you know I'm a fan of those 3 steps. So understanding your values, then narrowing them down to specific causes, and then coming up with a mission statement out of that. And I bet there's some folks who are listening and hearing that and thinking, gosh, that sounds like a lifetime's work. In some cases it probably is, right? But you also can do that in like a half hour, right?
Absolutely right. I mean, this can take 30 minutes, and it really depends on your the scope at which you want to look at. It also depends how many people are involved. But I've done this exercise with many donors in the span of just half an hour, to reaffirm or to discover their values.
And I like what you said about reaffirm, right? Because I know a lot of folks, like I said, like they've been doing philanthropy for years, they've been doing charitable giving for maybe their whole life. This is still a valuable exercise for them to do, even if you have something that's very refined, right?
Exactly.
Yeah. I'd love to do it. Just to kick in, I love seeing it done with folks who even have large foundations with very clear mission statements. The same activity, I know you and I have done it with some folks with those large organizations that are you'd think they don't need any more work, but the truth is everybody needs this type of work to get it done. You mentioned also about involving others in the giving. Can you talk a little bit more about that? I know folks talked about using philanthropy to get kids involved, and we're at the end of the year, so families are getting together. What are some of your thoughts about involving others in their philanthropy?
Yes, so thank you. And I advanced the slide already to talk about this a little bit. So involving your family or others in philanthropy really can take multiple forms. I would say that initially your decision making and preparing for eventual succession or including others should really start with first outlining the who, the what, the where, the what, the when, and the how. And first, discuss your goals, right? So be intentional about your decision making and who and why you want to engage others. And then from there, you can think about each perspective. So let's take family involvement, for example. Philanthropy offers lessons in money management and organization, and it can really help reinforce the value of hard work in individuals, as well as enhance just some professional skills, such as communication and accountability. And so on this slide, you could think about it in terms of exposing the rising generation to philanthropy helps them build confidence as well as cultural awareness. And some ways to do that are you could have them volunteer at nonprofits. So if they're a bit older, you can have them volunteer, do a little networking, make some connections. Maybe they get an internship or a mentorship, maybe even a job opportunity. And from there, they can even build some really meaningful connections in the community. Next, they could be collaborating with other organizations. So this could be something around, again, board experience if they're older, or perhaps they just listen in on a sort of monthly meeting. And then likewise, you could have them allocate a certain amount of funds to recommend charities to support. Or something you could do is have them evaluate where you've given in the past. And this can be honestly a fun exercise that you do with your children or any other sort of family member, sort of get that really raw feedback on what they think about your charitable donations. And I'll just mention that if you are interested in bringing family into your conversation, I recommend a quick read on our website. I wrote an article titled 5 Ways Philanthropy Can Build the Rising Generation's Financial Skills. And it really touches on a lot of these points and goes a little bit deeper into the opportunities that can help a family kind of think about growing some of those soft and hard skills in people.
Yeah, and I like, Abby, that you talked through there, just with some of those concrete examples of volunteering or reviewing, maybe your gifting, the way in which, just like what you did with the working toward a mission statement, those can be big things that take a long time and are very gradual over time, or they can be very low stakes things of just getting, you've been connected to an organization for a long time, they're sending you materials, offering you volunteer opportunities, take them up on it, let your children and let the other person in your family, let's go do this as a family together, right? And it's an afternoon or it's a couple hours. Those things are really simple ways of doing it. And even something like, hey, we're just about to make a gift to this organization. Why don't you take a look at it? Love to have your input on it, right? Very simple things you could do to involve some more people into your giving. I really like the way that's very concrete. Abby, I want to ask you the question, the kind of the reverse of my first question. So some people, know the dollar amount, but need to figure out sort of where they want to focus the resources. Some people kind of know the causes, know the impact. We'll talk about tax strategies in just a second, I promise. But maybe are uncertain about the dollar amount. And I'm wondering, before we talk about just the tax side of it, how you think about it from a sort of impact orientation, or also just how to think about ways in which to have more impact for the dollars that you give.
Yeah, and Brian, this is such a significant question. And it comes up so often when I talk to families specifically, because it is a very personal decision to determine how much to give to your focus areas, especially when they're thinking about preserving for their family now and in future needs. So my initial advice is to consult with your financial advisor around what makes the most sense right now in terms of the scope of your entire budget, knowing that this will fluctuate, it will change. And then once you understand the sort of how much in terms of what you can give, then you can think about the strategy behind your giving. So we go back to the values and focus areas that we were just mentioning before, and you really want to think about the focus areas that you are giving to. What kind of resources do they need right now? In some instances, they may need a really large one-time donation upfront, or maybe the strategy is a multi-year gift because there's a type of project out in the community that requires more long-term funding. But you can think about immediate gifts now, as well as reserving some funds for emergency giving, right? Those man-made or natural disasters that unfortunately will always arise. And so again, just thinking through what your values, your focus areas are in the scope of your overall strategic giving, once you understand the sort of the how much. And I have a great example, actually. It's very top of mind. I'm working with a family now, and after reviewing their financial budget for the year, they have allocated $200,000, very generous amount, to give to charity. And they actually allocate the entire amount to a donor advised fund. And then they have their 2 teenage children make decisions on about 50,000 of those donations, so 25 each. And then the parents have a few of their ongoing distributions that are just very personal to them. And then from there, they actually reserve a portion of their funds for emergency giving that happens throughout the year. It's one of the focus areas that they identified early on was disaster relief, and they find that it's important to just keep a reserve on hand for wherever they can help. And then whatever dollars basically aren't going out the door necessarily in the calendar year get to be part of their donor advised fund. They're invested, so they're earning more, and those additional funds get to go to charity down the road.
That's really great. And I like,
Abby, I want to interrupt you just a second because we've had quite a few comments about the background noise. I just want everyone to understand that unfortunately Abby's in an open space and the voices that you're hearing in the background is that. So there's not really anything we can do about that, but we've had quite a few people in the chat and the Q&A talk about the voices in the background. So that's what's going on there.
I see. Thank you. My apologies.
yeah, and we'll try to help send a message around to get people to be a little bit quieter. Well, so Abby, I want to come back to that dollar amount, but before we do that, I realize we've gone, a little ways in here. We need to probably clear the deck on the tax advantages of charitable giving. And I thought to set this up, I just go through this with folks. When we think about the tax advantages, or when folks think about how to make the most from a tax perspective of your giving, which you should think about, right? The government does support our charitable giving. So in a way, they do their own form of matching. And the way it works is that you get a deduction for income taxes. It's also, when you give, it's excluded from gift and estate taxes. But the focus usually at the end of the year is on income taxes. And the way we like to structure it, or the way I think about it, is first think about, there's three components of where you're giving, when you're giving, and what you're giving in terms of maximizing your deduction. So we first start with where you're giving. There's a number of different types of exempt organizations that you can be giving to and receiving an income tax deduction. The two major categories that folks are going to be familiar with are what we call public charities and then private foundations. By definition, every exempt organization is default to private foundation. But if you qualify and you're receiving enough of your support from public sources, as opposed from just the family or a few individuals, then you can qualify as a public charity. And certain organizations, educational organizations, schools, hospitals, religious organizations, they can automatically qualify as a public charity as well. And so when you're giving and you're trying to maximize your deduction, you're going to be better off giving to a public charity. Why is that? It's because the limits on your charitable deduction are higher. Now, for most folks, when we're giving, we aren't going to be pushing against those deduction limits year over year. Some folks do. And the reason for that is they're pretty high. You can give to a public charity, and if you're giving cash, you can give up to 60% of your adjusted gross income in a year and deduct all of it, right? You could deduct up to 60% of your adjusted gross income. So you can, knock down your tax bill by almost half, right? Depending on where the brackets lie. If you're for giving of cash to public charities, that 60% for cash is a special rule. Historically, if folks look at it or just searching online, you'll see a 50% limit, but the cash limit is still up to 60% for gifts to a public charity. And that includes gifts to a donor advised fund, if folks have it. We'll spend some time on donor advised funds in a little bit. If you're giving to a private foundation, however, your limit for those cash gifts is only going to be 30% of your adjusted gross income. So if you have your private foundation and you're making a gift to that as your way of, sort of charting your philanthropy or regularly funding your philanthropy, you're only going to be able to deduct up to 30% of your adjusted gross income. Again, that's for cash donations. But if you're giving something other than cash, if you're giving what we call long-term capital gain property, or sometimes folks refer to as appreciated property, really property that has gone up in value and you've held for more than 1 year, you can also get a deduction for that. In many cases, it's going to be more favorable because you can deduct for certain types of property, for marketable securities in particular, you can deduct the fair market value of those donations. And then the charity doesn't have to recognize the gain when they sell it after you've made that donation, because they're a tax exempt organization. The downside when you do it is your deduction limit is lower. So we give appreciated property to the public charity. That's going to be a 30% adjusted gross income limit. And then when you give the appreciated property to a private foundation, it's going to be a 20% limit, right? And you can stack it. So you could actually give appreciated property up to 30% to that public charity. and then give cash to get yourself up to 60%. And again, most people, that we work with aren't doing that regularly because, that's a lot of their income to be giving away each year. But for some folks, especially when you have big capital gain events, things like that, they're looking to maximize as much as you can. And the good news is, what do you say if you went over that limit, right? You gave more money than you had income in the year. Well, you actually get to carry that forward, and you have 5 years to use it. So you don't lose those deductions if you go over the limit. You just have to roll them forward into future years. So that's sort of the where. The when is the next question that we think about when it comes to the tax advantages of giving. And the goal here is really just to have the biggest impact. So if I have a lot of income in a current year, which means that next dollar, my last dollar of income is taxed the highest bracket, and then year coming up, I'm not anticipating the same level of income, it's going to make more impact for me to give this year rather than next year because I'm getting higher taxes this year. So we try to look at both years, and year end right now, I'd suggest folks do this working with their accountants. Look at where you're at this year, look at where you expect to be next year in terms of your taxable income, and then time your donations for the year that's going to have the bigger impact, right? If you've had a low income year this year, maybe because you're doing a shift between jobs, or maybe you're in retirement, but you haven't started taking distributions from your retirement accounts yet, or haven't started taking Social Security, but you're going to start doing that next year. Maybe you wait and you start doing your donations in January rather than December, so that you're taking the deduction in the year in which you have the highest level of income, or your income is at the highest bracket. There's some other things around when, we'll talk about those in a second, but I want to get back to what you give, right? So when I'm trying to order donations for folks, there's a few things I'm looking at. One is, like I said earlier, giving appreciated property. That sort of applies across the board for folks, because again, you can get a deduction, particularly for marketable securities that you give. So if you have a stock portfolio, and you can see that you're holding Apple shares, and those are highly appreciated because you bought them 10 years ago, those are great things to be giving to charity, because you don't have to recognize the gain when you give it. You get a deduction for the market value, and then the charity gets that same market value because they can then sell that stock without having to recognize the gain on their end. So I look for appreciated property as step number one. Step number two is for folks who are over 70 and a half. You can do what's called a qualified charitable distribution from your IRAs. So if you have your retirement account, you can have a distribution directly from that account to a charity, and up to $100,000 a year. And the way this works is that $100,000, if I assume you did the maximum amount, it counts against your required minimum distribution. So if I had an RMD requirement of $120,000, I could satisfy up to $100,000 of that by giving money directly to my charity, which means I don't have any income that year. I'd have to pull that other $20,000 off, but I can get $100,000 of that RMD done by going to charity and not having any income from that account. I can do that for any of my retirement accounts. So because that income is ordinary income to me, it's not capital gain, which means it's usually taxed higher. So that's the other thing that I'm looking at for what I give. And then there's some other assets that you can look at too. But Abby, I want to pull you back into the conversation. So when we talk about giving other types of property, what do you think about as additional concerns when, it could be the marketable securities, could be things like real estate. What do you tell folks they need to be thinking about when they start going down that path?
Yeah, thanks, Brian. And I'm glad you mentioned just that so many donors do use multiple types of assets to really stack that and give to charity. And so I would say, start by thinking about how you want to involve the charity. And what I mean by that is it's really important to think about any types of the relationship that you may want to build with a charity, or the communication that you want to continue to have or not to have. This helps really set up the parameters for any type of relationship, and especially if you're giving complex assets. Normally, you have to spend more time with the nonprofit in terms of making sure that they understand how to process your gift. And so a great thing to also look at when you're looking to give something other than cash is a gift acceptance policy with a nonprofit. So best practice is that every nonprofit have a gift acceptance policy. And what this does is it helps outline how they receive gifts and how they process gifts. So in its simplest form, it tells you, the donor, what assets they will accept, what they won't accept. And not every nonprofit will accept every type of asset. So this is an important step to understanding just how your partnership can work with a specific nonprofit and understanding their own limitations and where you might need to add in a third party. So no matter what type of asset you have, we at Fiduciary Trust actually help our clients all the time. We help to figure out these solutions. And so I can give you an example with that. It's actually around real estate. I'm working with a client who wanted to give their vacation home to charity. And this nonprofit is actually smaller in size, and they couldn't accommodate the scope of what it means to accept this type of gift, right? Because there are some liabilities and higher risks involved with this type of asset. So the client turned to us. We have a third-party partnership that we were able to involve to help the client donate the property to charity. And so the scope of sort of the timeline looks like this. The client gifted the property to this third party. The third party is a nonprofit in itself. So immediately the client was able to receive their charitable tax deduction. The third party nonprofit basically turned around and they sold the property. They take a small fee for their work, and then the majority of the proceeds go to the charity that the original donor had intended. And the great thing about this is, of course, all parties win. They all benefit from the donation. And more so, the smaller charity did not have to absorb the risk or the liabilities of this type of process in owning the property and then having to turn around and sell it. But they can still maximize the benefit by accepting these types of complex gifts by working with advisors such as us and different third parties. And so this is just one example really of ways that we get creative when working with clients in sort of the everyday charitable goals that are out there.
So I really like that story. One thing I know I've noticed over the years working with a lot of clients with very active philanthropy is that there's this whole class of organizations out there that do really impactful, meaningful work for our communities that are not really large yet, right? So they're very successful. They're very able to do what their goals are. They're often very reliant on communities, and especially if you're talking about sort of low-income communities in need. Often their constituents, the folks they're helping, are not folks who can do kind of transformational giving for them. They may be able to give just time and effort. And I've seen a number of these. I'm thinking about an arts organization. I'm in California, and they're on the coast in California. Just an amazing organization, took over a sort of abandoned locker room and turned it into a community arts center, and have hundreds of kids now in this community that are going through there, having the type of arts classes, community events that really otherwise wouldn't be present in this community, and the families really wouldn't have access to them. But organizationally, this is a group that I got talking to them because they didn't know how to set up a brokerage account to receive securities. They haven't had those types of funds in the past, right? They were working off of a checking and savings account. And so a lot of times those organizations that are just having amazing impact, they aren't set up to receive some of these larger gifts, but gosh, should they use them, and gosh, could they have a lot of impact? Definitely. So what you're describing about ways to facilitate it and make it easier for them, especially as they, like the organization I was talking about, sort of transition to building some infrastructure, that's a real way to have a real impact for an organization where you can sort of help them guide to realize what their vision could be as a large organization with more sophisticated donors, higher dollar donors. And, you can take some of the burden from them because that's time and cost for them to go set up, brokerage accounts, set up gift acceptance policies, things that large organizations have. If you can do some of that work, you don't get an extra tax deduction for it, but you do get an extra impact for it. And it can be really, really important for those organizations. You were talking about a donor advised fund, and we talked about donor advised funds in the past. So maybe, Abby, could you spend some time and do a little bit of a comparison of, well, just describe what a donor advised fund is. And I know they get contrast with private foundations a lot, and just work us through that.
Yes. And I have a helpful slide because I often do get the question, can you tell me what the differences are between a donor advised fund versus a private foundation? And so I will start with the donor advised fund. Some of you may already know we refer to this sometimes as a DAF, a DAF. And it's really simple and quite easy to manage and create. To begin, you open an account with a sponsor organization, and the donor receives an immediate charitable income tax deduction when the assets are gifted to the fund. And as an advisor to the fund, you then make recommendations to the sponsor organization on distributions to be made to charities of your choosing, charities that match your values and your focus areas and are part of your mission. And so something that's normally pretty attractive to a donor is that currently a donor advised fund doesn't have an annual distribution, and it is seen as sort of that public charity, right? Brian was discussing before the difference between giving assets to a public charity versus a private charity, and a donor advised fund is seen as a public charity. So when you're giving cash, you have a higher AGI deduction, as well as for appreciated assets. And one caveat too with a donor advised fund, however, is that the sponsor organization, they do have final control over the assets, and they have final approval as well over the distribution requests. So when you look at a private foundation is its own legal entity, and therefore the trustees or the board have full control over the investments and the grant making preferences of a private foundation. However, with a private foundation comes a few more distinct attributes. So you have to file special legal and tax compliance requirements. You have a 990 PF that you have to file every year. There is a 5% annual distribution from your funds that needs to go out to the charities of your choosing. And because it is a private charity, there is a lower AGI attached to that as well. And then you'll see a bullet point that just says donations are not anonymous, and that is because of your return. So when you file the return, in the return, you're listing all of the charities that you support with those donations out the door. And so, a private foundation or a donor advised fund, it depends on what your goals are. In some instances, it's either or, and in some instances, maybe you're utilizing both as a strategy.
Yeah, and I think also at year end, the donor advised fund becomes really useful tool for folks because, like you said, Abby, you can set one of these up in just a couple days. And for folks who have, we see it a lot with folks who are maybe selling a business and having a transaction this year, and so they want to make sure they get the charitable deduction in this year, and they're going to make a large deduction. So going through the thought process of where do I ultimately want this money to go? They'll have folks like me telling them, hey, you're going to have a huge amount of income this year. Why don't you pre-fund all the charitable giving you're going to do that you can really expect to do during your whole lifetime, right? Because you're selling your business. This is your big capital gain event. So, let's offset it with all the charitable giving you can see yourself doing going forward. You can do that with a donor advised fund. You can do it pretty quickly where, you're going to say, hey, I can see myself giving, $100,000 a year for the next 20 years, right? That's a couple $1 million, right? I can be selling my business for, 5, 10, whatever amount it is, and say, you know what? I know I'm going to give away $2 million over the rest of my lifetime. I'm going to do that gift to a donor advised fund today, and then have that money, have the deduction for it this year, but then I can spread those deductions out over the the rest of my life, and I can do that really quickly. Private foundations, I think we're in November. Abby, I don't know if you agree with me, but I'd say this is probably a little bit rushed. You probably could get it done, but you're going to be rushing to get it done, and that's probably not the best way to approach something that's really should be designed to be lasting for a long time, like a private foundation.
I agree. Right. The timeline, you said it well, Brian, the timeline for a private foundation is just a longer runway, and a donor advised fund, it can be set up really quickly. I've seen it set up in as quick a process as a week. So or just a couple of days, and you still get such a large tax advantage with the donor advised fund. And I'll also mention that I talk to a lot of families about setting up a private foundation because they want their family to be involved. Family members can also be involved in donor advised funds, and there's strategies there to help involve rising gen and kind of get into a more broader involvement with other people. So I wouldn't limit yourself if you are also weighing that option.
Yeah, I would say with donor advised funds, you can set them up quickly, but you want to make sure you think through all the options that you have, right? And what do I mean by that? When you set up the donor advised fund, you have the sponsoring organization who's going to hold the fund. You want to be thoughtful about who that sponsoring organization is. Make sure you feel like you have a good connection with it, whether that's a financial institution that's behind it, or whether it's a community foundation. You also want to make sure you've laid out not just yourself as an advisor, but thought through who your successor advisors, who are those people who are going to direct on the distributions from that fund, or give advice to the sponsoring organization about where those distributions are made. You want to make sure that you've thought through just not name yourself, but have a successor. And also, what's the backstop? How does the organization work if there is no more successors to do that direction? Are they looking at your past giving? Are they making decisions themselves? Do they have a narrow focus like a community foundation may have, where that's going to guide where the funds go? You should have control over that, so you want to make sure that you've thought through that. And there's also investment decisions to go with the donor advised fund. So understanding the investment decisions, how much it costs. Donor advised fund, I think Abby said it, is a less expensive option than a private foundation typically, but still you should understand the cost that goes along with it. Abby, we're getting close to the end, so I want to make sure if folks have questions, please go ahead and write those in. We were talking about year-end timing. For tax purposes, I know this is a question we get regularly, is what do you need to do before the end of the year when making a charitable gift? So if you're cutting a check to an organization, if you still do that, the rule for gifts to charity is actually a little bit different than gifts to individuals. If you're making gifts to individuals, you really want that check needs to clear this year. So just we always tell clients, if you're handing gifts out to family members in Christmas, you got to monitor them, because they really need to go and take the picture of it, or make sure it's deposited by the end of the year. Even if you're doing it in Thanksgiving, you still got to make sure that they actually cash those checks this year. It happens all the time. With charity, it's a lot easier. If it's a check, you just got to make sure it got postmarked by the end of the year to get the deduction in the current year. Better yet, you can do electronic transfers or wires or credit transfers. A lot of folks do that. It's just so simple. And that's where you want to make sure that transaction goes through this year. When you're dealing with larger gifts, or you're dealing with actual property gifts, that's where you have to give up, what we call dominion and control. So you really want those transfers to settle, all the paperwork to be done, and clearly the property in the hands of the organization by the end of the year, by December 31st. So again, you get close to the year end, don't play around with those timelines. Nobody likes rushing. That's when mistakes get made, or you just don't have the time to think through all the repercussions. So make sure you're taking the time to do that. The other thing, I meant to mention this earlier, I think it was on one of our slides, is if you're looking at the end of the year and doing gifting, and I mentioned looking at the 2 years, current year, next year, to have the biggest impact on where your deduction is going to fall. if you do not regularly itemize your deductions, meaning you're not over the standard deduction for individuals or as a couple, you also want to look at possibly bundling. This is what we call bundling your charitable gifts in one year or another, so that you have a year where you kind of bump above that standard deduction and therefore get some additional deduction for those charitable gifts. Because if I'm below the 13,000 roughly of the standard deduction, and I'm making charitable gifts, but then don't push me over that amount, when I look at my other things, my mortgage interest deduction, medical expenses if I have them, state and local taxes, if say all of those are $10,000 a year, and I'm an individual, and I'm giving say $3,000 a year, I'm not going to be above my standard deduction. So I'm not going to get any extra benefit of those charitable deductions. But let's just say, hey, you know what? I do this every year. I'm really clear on my mission, and I want to give to the same organizations for the next 3 years. Or I have a donor advised fund, and I can sort of parcel it out as I want by giving to that donor advised fund. Well, if I take, let's just say even 2 years of charitable gifts and do it in the 1 year, right? My $3,000 is going to push me up about that standard deduction level. And then I can get a deduction for that additional $3,000 that I give away in the current year, because now I'm over the standard deduction. I'm able to itemize. And so that's what we mean by bundling your gifts. And that's something to look at too if you don't regularly itemize your deductions. So if you're always itemizing, great. Make the donations in the year where you're going to have the highest tax and highest income tax, and also just factor in the carry forward as well. Abby, I want to get some of the questions, but go ahead.
Yeah, so Brian, we do have a question in the chat, and it relates to a question I actually had as well, which is, what about more complicated gifting from kind of complex structures, like charitable remainder annuity trusts or charitable lead trust? Maybe you could address that.
Yeah, sure. So first off, when you get into more complex structures, just like we were saying with the private foundation, you want to make sure that you're giving yourself time to go through the process. You get into a charitable lead trust or a charitable remainder trust. These are things you need to be working with your attorney, as well as with the CPA, and probably also wealth management folks. So you're looking at it from a number of different angles. All that takes time, takes coordination. So if you're looking to do that before the end of the year, you really got to you got to get really busy on that right now. The other part of it is be really clear on your purpose. So I'll talk about charitable remainder trusts. These can be a great option for folks who have a few things going on, right? The way these trusts work is you make a donation to the trust, you get a current income tax deduction, and you also receive an annuity stream from the trust for either a period of years or your lifetime. And then at the end of that period of time, the funds go to the charity that you designate, whether that's something you designate now, you can draft it so you have flexibility on where those gifts go at the end. And that remainder interest that's going to charity is what you're able to value today and get a deduction based on. And what's interesting about these types of trusts is that they are a great solution for folks who are selling their businesses. So if I'm selling my business, for a lot of folks, the goal when you sell a business, sometimes you're folding it into a new business, but for a lot of folks, it's, hey, this is going to become my nest egg that's going to take me through retirement and be something I can draw on for the rest of my life as, in essence, an annuity stream. And a charitable remainder trust is a way to accomplish that goal. If you also have this goal of, hey, when I die, I also want to leave some money to some organizations that have had a big impact for me. If those two things are true about you, a charitable remainder trust becomes a great income tax strategy, because the charitable trust, if you give the business interest to the trust, like we're talking with donor advised funds, they're able to sell it without an immediate income tax burden. And instead, that income tax burden gets spread out over a number of years based on that to match the annuity interest that you're taking out. It's something that's a lot easier to draw out with a piece of paper. But that goes to the point that you really want to understand these things and take the time to do them, because they can be great options to employ if you're looking at it. There also, I think there was a question we got before the session on current developments around charitable giving. And one big development is that we've had this change of interest rates. And so as interest rates have gone on, or gotten higher, there are some strategies that have become more favorable. So when you do some of these annuity strategies, where you're receiving back the annuity from this trust, as interest rates go up, the calculations get a little bit more favorable for the taxpayer. And folks who are giving to large organizations and possibly looking at things like gift annuities, those get more favorable as well. So with the larger, more complex giving, you want to make sure that you're giving yourself time to think those things through, make sure the strategy aligns with what your goals are. But if it does, they can be really great ways to make the most out of your giving.
How about any other kind of year-end vehicles, other than you talked about the donor advised funds and how they're easiest to give things kind of at the last minute for year-end giving? Are there other structures that people can take advantage of as well?
So I think we've covered them. Your main structures for giving are going to be either giving directly to an organization, and you can do unrestricted gifts to organizations. You can give restricted gifts to organizations. You want to think about, sort of the impact on the charity of their ability to administer them, because that's a cost that they have to incur. But you can give restricted gifts to organizations, whether that's something you create or endowment funds or other funds that they've created for themselves that you can add to. You can work with an organization to do things like matching giving. These are all great options, but your vehicle really is a direct gift to the organization. If you're looking at an indirect gift, which means there's something in between you and the end charity, your options are really going to be, again, the donor advised fund, which is probably your simplest version, your private foundation, which really works for folks who are looking at, long-term, multi-generational giving, or really want to have some control around a charitable entity for their own family. And then charitable trusts, which are really tax planning vehicles, whether it's income tax planning with a charitable remainder trust, or we didn't talk about too much, but estate and gift taxing planning with your charitable lead trust.
Well, this is a question probably for Abby. You talked about it a little bit, Abby, addressing the next generation, but can you discuss strategies for the very young family members, maybe or upper middle class families, to make the most of their charitable dollars?
Yeah, that's great. So families can always engage children in education and nonprofit involvement. And it's kind of along all age groups, right? All age groups benefit from thinking about their personal values, their focus areas, and those will change, especially if you start younger. And then as they develop, they have life experiences, they get jobs. You expect that their values and their focus areas will shift. So it's good to have those conversations kind of throughout as they continue to grow. And the scope of activities that families or children can get involved in just depends on the ages. So as an example, I run an exercise with our clients who have school-aged children, and I help them with budgeting. So we have like these budget coins, and we talk about what it looks like in the overall budget versus allocating a certain percentage or dollar amount. The children understand that the funds come from somewhere. There's a very large pool of funds, and that a certain pool of funds is allocated to charity, and they get to help participate in where those funds go. And so again, it's just breaking that exercise down in the context of talking about a budget, but you're making it a simple and kind of interactive exercise, so that way that age group can really participate. And then as you get older, you may have those children volunteer at a nonprofit and understand more about where the finances go, how the dollars that are coming in the door into that nonprofit are actually being used for the programs and services that are going out into the community and helping individuals. And then beyond that, if you do have a private foundation, perhaps you let those adult children or older children serve on the board or participate in board meetings and understand the operations of your nonprofit. So as I mentioned, it's just there's quite a variety, and if you I'm of the mindset that it's never too early to start to educate your children and the rising generation about philanthropy and getting them involved in some interactive exercises.
So Brian, this question's for you. And I don't want to put you on the spot here, but you talked already about the changes that are happening in our economy, like interest rate. What about some of the legislative changes that might be happening? I know that there was a movement, certainly in the President's Green Book, around tightening up some of the rules around donor advised funds. I think there was some concern that more people were going to donor advised funds to maybe avoid the 5% distribution rules from a private foundation. No movement has really taken place on that, but are there some other legislation or legislation that you're aware of that could change some of the abilities for families to do their giving?
Yeah, so I think you've hit on the main item I look at, and the reason for that is, and I think Pat, you know this better than anybody, to have legislative change, we need to have action in Washington, which is a challenging event in these days, and so while there are a lot of proposals that circulated and certain things that have been in the President's Green Book for multiple years, and things that have been in President Obama's Green Book before that, still are in circulation that would sort of tighten our tax rules. The private foundation donor advised fund rules, those have been one thing that have had bipartisan support in the past. So I look at them as something maybe a little bit like the changes we've had around retirement accounts. So, we saw recently probably the most impactful tax legislation that we've seen was our Secure 2.0 Act, which made some pretty decent changes around retirement plans and encouraging folks to be involved in retirement plans. And we saw that with bipartisan support, right? And so the bill that has been in circulation has had bipartisan support. And really what it would do, as Abby went through that chart comparing donor advised funds and private foundations, would be to bring them closer together. And what do I mean by that? I mean, one concern around donor advised funds has always been that folks give money to those funds and then the funds just sit there, right? Taxpayer got a deduction for it, but charity communities never got the impact for it. When you look at the numbers and some of the huge donor advised funds that are out there, we do see funds going out there. So, there's a little bit of debate of whether we really need the legislative movement to sort of push the money out of the donor advised funds. But there is an effort just to make sure that, okay, a minimum percentage of what's in a donor advised fund is getting paid out to charities each year. Also part of that would be some tightening of the rules around donor advised funds. There's folks who have private foundations know that there are sort of strict rules around self-dealing and the different types of transactions and the different types of, especially with business interests, things that can be held by a private foundation. A lot of those rules apply to donor advised funds, but not all of them in the exact same way. So there is some effort to try to bring those two things together. Some effort also, again, the concern is folks are using charitable dollars for personal purposes and not getting them out to the community. So there's been some, proposals around limiting the way the compensation that can be provided to sort of family members that are part of private foundations. So a lot of this is out there on the radar. I think it's worthwhile for folks to be aware of and thinking about who are engaged in philanthropy. Whether any of it comes to fruition, we'll just have to wait and see.
Well, that is very helpful. So I'm going to hold the last question. It's kind of a complex question. It was from one of the individuals that registered for this webinar. I hope they're still on. So let me read it to you, and I think it's directed at you, Brian. For an individual over 70.5 years old who still has significant wage and real estate income, what are the pros and cons of making charitable gifts to various 501c3s by each of the two methods? A, transferring appreciated marketable stocks to a donor advised fund and making distributions from there, or B, making distributions totaling less than $100,000 a year from an IRA, which arose from the transfer of assets from a 100% company-funded traditional profit-sharing plan.
Okay, so I think your answer there is actually kind of straightforward, and I will kind of simplify it for folks who may be in this situation as well. So you're a high earner, right? You're old enough, you're over 70 and a half, where you can make these qualified charitable distributions from your IRA. I'll take it a step further and say that you're over this year 73, and you're actually required to take distributions from that account. If that's your case, right, and you're a high earner already, and now you're gonna have to take an RMD from your retirement accounts. So a lot of folks, that's $100,000 of income that's gonna get stacked on top of your real estate and investment income. So it's probably gonna be up at the top tax brackets, right? And it's ordinary income. So we're not dealing with capital gains rate, we're dealing with ordinary income tax rates. If you're in that situation, your first charitable giving should come out of the IRA, right? It should be those direct payments from the IRA to the organizations, qualified charitable distributions. If you got the wherewithal to do it up to $100,000, that is typically the first place we're guiding clients to do it in that bracket. And it's the first place, a lot of our high earner clients are doing their gifting. If you've already done that, then I could say, okay, now let's look at the appreciated securities, to go over the 100,000. If you're not in retirement yet, or you're not over 70 and a half, I would say start with the appreciated securities. And then once you get over 70 and a half, you can look at those qualified charitable distributions. The subtle question I get out, I'll throw it in there in case anybody's in this situation, is we have a little bit of a disconnect in the rules right now, where you aren't required to take distributions from your IRAs until 73, from your traditional IRAs until 73, but you can make these qualified charitable distributions from your IRA once you're 70 and a half. So that's why I'm kind of flipping between those two numbers. So let's say you're 72 right now, right? You don't have to take RMDs, but you can do qualified charitable distributions. I would work with your accountant to make sure you understand and know the numbers, but it can be making sense to take that money out of your IRA and do the qualified charitable giving distributions from the IRA, even though you don't have an RMD, because what is that doing? It is fulfilling your charitable goals, getting the charitable giving done, but it is decreasing the value of that IRA. So the RMDs later on are going to be less, which means less income for you. It's going to depend on your circumstances, but I would say if you're in that 70 half to 73 range, work with your CPA to make sure you're optimizing for what you do.
Excellent. That was a great answer. Well, I think we're at time. So do either of you have any concluding remarks you'd like to make?
I think one, and Brian already touched on it, is just a broader thought about charitable giving. And you don't have to wait until year end to make your charitable distributions to be charitable. There's a lot of strategies that can help you accomplish your goals, and so some of those do require more time, and it's the sooner the better sometimes in planning.
Yeah, and I'll agree with Abby. I think that was a great final point, and just say thank you for everybody for joining us. And Pat, thank you for having us.
Yes, thanks,
Absolutely.
Pat. Thanks, Lauren.
You're very, very welcome. And I would agree, plan early. It's already too late. So start planning right now, because the year will be here. It'll be over before you know it. So thank you all for joining us. Thank you, Brian. Thank you, Abby. Everyone have a great rest of your day. Take care.